Hello, fellow traders. I'm Dylan, a research strategist at Pepperstone, bringing you the latest weekly update for As Good As Gold. In the gold market, sellers take charge when investors actively shift their exposure to riskier assets, particularly in the tech sectors of the U.S. equities. So let's start by examining the overall performance of gold. Over the past 5 days, gold has experienced a widespread decline, dropped by 1.8% against the US dollar. And at the same time, this trend is not reversed when traded in weaker currencies like the Aussie dollar, indicating a general waning interest in gold. Now, turning to the daily chart of gold against US dollar, a distinct downward pattern is evident since the local high in 2009 US dollar 2 weeks ago. After struggling above 1981 last week, the price breached significant support on Monday, leading to a 3-day decline. Gold is currently trading below its 5-day EMA, testing the 1952 level. If the September high fails to provide support, the 200-day moving average could act as the initial support before reaching the psychologically significant 1900 level. On the upside, attention should be paid to the market reaction around 2000. Consider a potential resistance. As for the reasons behind the bearish movement, the easing of concerns about geopolitical tensions in the Middle East plays a crucial role. As people become more convinced that the issue will be contained, the need for risk hedging diminishes, prompting a shift in focus towards alternative investment. The recent sell-off in gold can also be attributed to the robust rally in U.S. tech equities, especially the Magnificent Seven, including Microsoft, Apple, and other 5 big names in tech. With the Fed signaling the end of the rate hiking cycle and last week's cooler non-farm payroll prints, investors are inclined to increase exposure to risky assets. The NASDAQ 100 has seen an 8-day consecutive increase, nearing the record set in December 2020. Simultaneously, the S&P 500 has risen by 4.5% month to date, confirming the local high in October. Given the substantial gains in these indices, driven by tech giants, gold appears less attractive as a zero-interest asset. Well, despite the recent bearish movement, there is optimism for the longer term. The Fed's indication of the end of the hiking cycle attracts buyers in the U.S. Treasury market, particularly in the long end. The 10-year yield has dropped for the third consecutive week, totaling a 53 basis point decrease to around 4.5%, a level last seen in late September. The spread with the local high has expanded to 57 basis points for the 30-year, currently trading around 4.61%. If the Fed maintains the rate unchanged in the December meeting, this trend may continue, reducing the opportunity cost of holding gold and potentially boosting its price. Additionally, discussions of a U.S. recession have emerged after soft labor market numbers, as the same recession indicator will be triggered if the next job report results in an unemployment rate above 4%. Despite the Q3 GDP showing the resilience of the U.S. economy, the fear of a recession may shift investors back to gold when the tipping point arises. So, in summary, the gold market currently leans towards the bearish side. Reduced concerns about the Middle East conflict and the impressive equity performance in the tech sector cast a shadow on gold prices. However, Treasury purchases and concerns about a U.S. recession provide a glimmer of hope. Finally, a crucial event race to monitor is the U.S. CPI print next Wednesday. While the consensus suggests the rate hike is complete, a significantly positively skewed outcome could change market sentiment and influence the Fed's rate decision in December and potentially setting the tone of the rate cuts in the coming year. So that's all for this week. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading.